Hello, everybody. Welcome to the TraderMerlin Show. It is your Monday edition. Hello, Jorge, Zach, Tomasina, Chuck, Les, of course, Cape Canaveral representing today. We got Miles, Jerry, Big Eben, and Alex, a friend of mine from Northern California. Good to see you here, my friend. He's gone on to do some great things with baseball. Alex, don't feel intimidated by the group. I know you mentioned in an email that you're just getting started at this and feeding yourself with as much information. Feel free to ask questions. If I don't get to them, the group in here usually does. And hello, Tom. Good to see you. All right, guys. Today is going to be a great day. I've managed to coerce my guest today to do a once-a-month appearance to talk about 4 broad markets. That's bonds, equities, currencies, and commodities, also called the B.E.C.C report, something that he's been kind of doing for his students for years. I'm pushing him to do it much more commercially because I think it's an extremely valuable report just to look at the broad picture once a month to see what on earth is going on with different markets. Of course, for those that know, I'm talking about none other than Mr. Scott McCormick, CMT. How you doing, Scott?
Doing well, Merlin. How are you?
I'm great. I mean, I'm on lockdown mode, so I can't complain too much. What else am I supposed to do?
I know. The moment I saw that order, I felt for you guys. You know, I live in Texas. There's no lockdown.
Yeah. Well,
I mean, even if they threatened it, there would be like a complete revolt.
You know what? It's starting here. Actually, one of my favorite restaurants I go to, they just posted on their social media that they're kind of linking up with other restaurants saying, look, we abided by every COVID protocol. We're doing everything in our power to keep as clean as possible. We got masks on, gloves on, shields on. Let the customers make the choice whether they want to come and eat here or not. And I'm like, you know what? I'm on board with that. I'm on board. But anyway, we won't make this a COVID political show. We could go on and on about that one. Because I'm on lockdown. I got nothing to do. All right, as I center my screen here, Scott, it's been exactly a month. I think last time you were on, it was election time. We were talking about the elections. And, of course, for the most part, we know who won the election. Of course, anything's possible. We still have probably, I think, another week or so till the last state has to report their final tabulated votes and make it official. But let's just assume we've got Mr. Biden stepping in as president here coming up soon. Anything change with regards to that bond, equities, currencies, commodities report you'd like to look at? Any major stuff?
Yeah, so I think it's probably important for any new listeners to be aware that whenever I go through the B.E.C.C report, it's really kind of done that first Thursday of the month. You know, this goes back to when I first started doing this, because when I first started doing it, it was for a group out of Rockville, Maryland called the Society of Market Technicians. And so I would always present the first Thursday of every month, and I would take them through the big picture. And because of the frequency of our meetings or lack thereof, it was once a month. So I figured, okay, well, if I want to give them relevant data to kind of move forward with, what could I do? And it just really kind of evolved from there, and it became a regular practice for me even after I left the Washington, D.C. area. But in terms of monthly changes, I would say that the biggest thing that I saw in terms of equity markets last month was that we had a bullish close above the September and October highs for the S&P, the Russell 2000, and the Dow Jones. And the Russell 2000 actually had broken out and closed at all-time highs. Now, I always like to focus on the close, whether it's as a swing trader, kind of like an intermediate short-term to even a long-term trader. Looking at those daily, weekly, and monthly closes is important because they're committed to those positions for that period in time, basically. And so, as I was looking at the equity markets, with those bullish closes that we had last month, the thing that is really important about it, in my opinion, is that it's showing that we have a breakout, and it's a continuation, if you will, of the next impulse phase. So if we were to consider for a moment the S&P 500 and the move from the March lows to the August, September highs there, from a monthly chart perspective, one would look at that and say, okay, well, relative to what's happening right now, that was our initial impulse. Now that we're getting out above the highs from the last 2 months, or I should say September, October, that being kind of corrective in nature. Now, if we're moving into that next impulse phase that actually suggests that there's a lot of upside. As this morning, going through what's called the guided pathway session for Online Trading Academy at 8:30, at about 10 to 7 local. So I'm in Dallas, Texas. So about 10 to 5 your time, 10 to 8 on the East Coast. We go through and we start taking a look at broad markets. I'll get into futures and sector ETFs. It just depends on the day, and because this was the first Monday after the end of the month, I took a look at these, and currently the measured move, if we take the distance of the swing from the March to the September highs or August highs, and then project that from the lows in October, it actually suggests that versus this morning's open, we've got about another 25% to go inside of the S&P 500 before we start to see any type of like major tops like what we saw at the beginning of this year, or even going into the latter part of 2018, or even going back into kind of that sideways corrective action that we saw back in the summer of 2015, going into the the early winter there of 2016.
Right.
So that's kind of like the big thing that I'm seeing. And in terms of equity markets, now when one of the other things that I always do is I always look at my relative strength analysis of key asset classes for a portfolio. So if you look at it from, let's say, if you're a client at Merrill Lynch or Fidelity or Schwab or any of those firms, they're always going to have that pie chart. They're going to have that stocks and bonds. And if you break it down, on the stock side, you're always going to have large cap. You're going to have small cap, which includes mid cap. You're going to have international, maybe emerging markets as a subset of international. And then on the bond side, it's typically broken down into government treasuries, corporate bonds that are investment grade. You have high yield, so AKA junk bonds. You're also going to have municipal bonds, agency bonds, to kind of really round out the portfolio. So what I do is I like to look at each of these asset classes versus kind of key benchmarks. So one of the key benchmarks that I'll use is the S&P 500. A major development on the equity side is that if you do a comparison of the Russell 2000 to the S&P 500, whether it's the cash indexes or even the ETFs, IWM versus SPY, a major breakout actually took place over the course of this last month. And that's pretty significant because it's one of the first times that we've seen any real outperformance of small caps versus large caps since late 2018 or early 2018. And if this trend continues, it's actually fairly bullish for the rest of the market. I mean, the old adage is that small caps lead into a bear market. They also lead into a bull market. And so the fact that we're seeing the small cap stocks, which have been underperforming from about mid 2018 to early 2020, now outperforming, that's a pretty significant shift. And so it suggests that from a long-term perspective, we're more likely to see more upside in the equity markets than the downside.
I've got a whole bunch of charts up here, so hold on, let me try to catch up to you because you've been doing a bunch of stuff. I'm going to look at the S&P 500, and I just wanted to make sure I got that right. So I drew up the S&P, and you're saying from those March lows, which I think, it's not on snap mode. 1 second as I throw it to snap mode. So I'm just using the futures to kind of give a ballpark, and I'm using that Fibonacci extension tool, going to that peak that we saw back in, looks like October, to those lows. Once you get that, what levels are you using on those extensions? Because I know the Fibonacci extensions are typically 38%, 61. Is there a special number you look for?
So whenever I do a measured move, it's the 100% extension.
Holy cow! Really?
Yeah, and so and I'm using the cash index, so it's SPX.X if you're or $SPX.X if you're on TradeStation, $INX if you're using the because $SPX.X is the CBOE data. I forget who INX is supplied by, but either way, when you measure this out, the measured move for the most recent swing actually puts it out to about 4350 S&P, and in taking a look at one of the other measured moves, and I think maybe we talked about this before, if you're on a monthly chart, you actually measure from the lows of 2009 up to the highs there in January of 2018, and then project that from the low of March 2020. We actually have a forecasted measured move, just in 100% projection of about 4,400.
Yeah.
And so the fact that we actually have those two levels kind of coinciding with one another, that would be considered an area of confluence in the market. It kind of increases that, or I don't want to say it increases the probability of a top taking place there, but it can act as a magnet psychologically.
Right.
And
the only reason is because you got so many people looking at it, right?
Exactly.
Yeah.
Exactly. Because if you have enough people, enough institutions that are looking at that saying, well, the market's going to get up to about 4,350 before it really tops out, then they're less likely to sell before then. Right. But as that market gets up to that area, I wouldn't be surprised to see them starting to scale back some of their exposure on some of the big stocks that they've had that have run up. And when you take a look at some of the names that are out there, I mean, there's a ton of stocks that are up over 100% from their lows in March. And when you look at the broad market, you wouldn't think that's the case. But there's a lot of stocks that are out there that have just had some really awesome years so far.
Let me kind of take a step back here as we look at these equity markets, which are, historic levels. Obviously, they've never been this high, and you have a situation where the fundamentals generally aren't that great. I'm certain they're getting better, but they're not back to the levels we were seeing back in 2018, 17, 16, even 19. Right, this whole COVID thing really just skewed it all. Now we've got on this plate another proposed $900 billion. What do I want to call it? Aid package. Stimulus package is what I was looking for. Sorry. I can't think of stimulus on a Monday morning. Does that factor in at all? I mean, a lot of people are saying it's priced in. I mean, I look at this market, especially those charts that you've been analyzing, and I agree with you. It looks like it still has room to run, but what do you think is going to continue to propel it? Is it going to be the stimulus? Is it the market actually getting back to normal? I mean, 4,500 is a hell of a long ways away from current valuations.
It sounds really far away, but when you start to put it into percentage terms, 25%, it's not that far. I mean, we could hit that within a year.
That's true. That's a November, right?
Yeah, I know. So by November next year, you can mark my words. No, I don't do that. It's like one of the things that I learned going through the CMT process from my mentor was, if you're going to forecast often, right? Because conditions change. Yeah. And I think to answer your question, I think what the market is probably still looking at is that one, even though there's reluctance or has been reluctance recently to pass some sort of stimulus package, they know that politically they've got to do it, because if not, the economy is going to tank, and one party is going to take the blame over the other. But the Fed has been wanting to put money into the system. They've been begging Congress for months to do something, and they just haven't for one reason or another. And I think that the other part of the possibility of a continuation here really kind of goes back to the idea that if this whole COVID thing goes away, which, whether it's through vaccine or just natural herd immunity, whatever it ends up, getting rid of this thing, or at least slowing this down to where the economy can actually go back to even like 85 or 90% capacity compared to where it was prior to this whole situation. I think the market is looking at that and looking at the prospects of that. Because they know it's not gonna be like this forever. Right. And if it is, if this is the new normal, then companies will adjust, businesses will go away, others will come to fruition. I mean, it's true of any other, long-term economic cycle. I mean, it's like there are certain companies that are around in the 20s and 30s of the last century that just simply aren't here anymore today. Right. Technologies change, and so when I'm looking at this, that's where I think the market is really kind of looking. And when you take a look at, because one of the other things that I look at is the relationship of bonds to stocks. Typically, that rotation into bonds, and the primary comparison that I use is the TLT versus the SPY. So we're looking at like 20-year plus maturities for government treasuries versus the S&P 500. Whenever I see that ratio going up, that's telling me bonds are outperforming stocks. And if I see that ratio going down, it tells me stocks are outperforming bonds. But from a security standpoint, obviously institutional money will try to move into those bond markets as quickly as possible if they actually see things starting to break down or storms coming. And when you take a look at the ratio since those highs that it actually experienced back in March, all it's done is just continue to trend down, and it's actually at a point right now to where it's on the door of, or breaking through this door, if you will, this level where it turned back in January.
What are you looking at here? Because I don't have a ratio. I'm trying to bring up the charts as you follow along.
So, are you on TradeStation?
Yeah, I'm on TradeStation.
Yeah. So if you type in like TLT on a weekly chart.
Yeah. Okay.
And then right click or just add a symbol.
Yep. Add symbol.
And so you'll have to add the SPY.
Yep.
And then if you go to your indicators.
Yep.
And add an indicator, there's a thing called spread ratio.
We will get that one here second. 1 second. Bear with me as I type. I'm doing this all live, guys. So spread ratio, done and done. Okay? And that's down at the bottom.
So now, so if you just kind of click and drag the horizontal aspect there for the TLT and the SPY up towards the top, so it expands the chart on the bottom there. You'll be able to see on a weekly chart. There's a pretty nice downtrend that's been in place, and we're about at that spot where there was a support level from the spring of 2019 where it had actually turned in January of this year before spiking up above that 70 level. So right now we're at about 42.42 as of the close today.
Yep.
And if we get a weekly close below that 40 level, then I would expect that there's a continuation of this downtrend. And with that, I would expect that stocks are going to continue to outperform bonds. And of course, I would personally start to move in and take a look at specific areas within the stock market that actually show relative strength versus the S&P 500 to take advantage of that.
When I look at this, Scott, obviously, and for those that watching me draw along at home here, I just scaled out. I zoomed all the way out here, and this is the weekly TLT versus SPY, kind of the spread between the two. Clearly, from those March lows, we've seen a really aggressive downturn, but it's coming right back down to those lows that we saw back in 2018, 19, and early 20. How much lower does this go, and what does that signify? Because to me, it's getting back to normal levels.
And that's one thing to look at, right? Because if you take a look at the range, for instance, that this ratio traded in during late 2018, fourth quarter 2018, basically through the first quarter of 2020, you would think that, okay, well, it's normal for this market to kind of just trade in a range. And the way that I've always kind of approached this is that if I see a situation like that where, we have a ratio that's kind of trending sideways, then from a portfolio allocation standpoint, what that would tell me is that I need to have as close to a 50-50 weighting of stocks to bonds in my portfolio as possible. If I see that the ratio is trending up, much like what it started to do in the first quarter of 2020, and if you go back to the fourth quarter of 2007, basically up through the second quarter of 2009, a situation like that would tell me I need to have more exposure to stocks than bonds, so like a 60-40 bond stock exposure as opposed to a 60-40 stock bond exposure. So right now with this trend, I would expect that, if trends continue until they reverse, thank you, Charles Dow, I would actually expect that the support level would break, much like what happened going back into 2014 through 2017. Because if you take a look at that period in time, you can see that, for nearly 3 years, there was a sideways ratio that took place there, and eventually we did break down going into the first quarter of 2017, which coincided with a fairly strong market until we got up into the fourth quarter of 2018 and we saw that sell-off. So the implications will be pretty significant if we do break down below that support level at about that 40 area, which is why I'm suggesting that if we get a weekly close below 40 from a ratio standpoint, then it's really kind of giving me a green light for strength of stocks to bonds. The other thing that would be important here as well is that, when we're looking at this ratio, we have to remember that the ratio itself is just simply a ratio between the value of the TLT to the SPY.
Right.
So when we're looking at, a level of 40, it's going to have less significance to the actual price of the TLT and the SPY. So I would need to look at the TLT and SPY directly and analyze the trend and support and resistance levels on those to say, okay, well, what's most likely going to happen here? Because if you do take a look at the TLT, for instance, if you spread that chart out, you'll notice that we've actually been pretty weak here since those highs going back into August. Mm-hmm. And one of the things that I'm watching for the TLT is that we have basically been in the sideways range between about 153 to 171. So if we see that the TLT actually breaks down below 153, then that in itself would actually cause that ratio to actually decline, even if the S&P 500 remains unchanged.
Right.
Now, of course, the prior trend on the TLT is going sideways. And so in this particular situation, if the sideways trend continues, then I would expect that the TLT would probably trade back up towards around that 171, 172 area. But even if it did that, if the S&P 500 is going up faster than what bonds are, that ratio itself can still trend to the downside.
Right.
And so in a situation like that, all this ratio is really telling me right now is that I just need to have more stock exposure than bond exposure to my portfolio. Now whether I would go long on the TLT or short on the TLT will depend on what that underlying product is actually doing.
When we talk about going long on the bond market versus the equity market, long equity market versus the bond market, mm-hmm. We're kind of going back and forth between the B.E.C.C here. But with the bond market, we have the situation where the Fed, it seems that they're going to be interested in obviously keeping rates as low as possible. You're seeing the dollar continue. Maybe we can talk about the dollar in a second because that's going to be in the currency side of things. But I've had Bill Addis on the program a few times. I love having Bill on. He's just an absolute wealth of information. And he was talking about the steepening, which is the fact that the Fed, the Treasury is going to have to start offering a higher yield for these long-term maturities because they're selling more than they ever have, which, is nice because it's preventing that inverted yield curve again because the longer-term stuff is going up. But how does a rising interest rate environment for the 30-year and the 20 and the 10-year impact your analysis?
So one of the things that I pay attention to, so once I go through like my relative strength analysis of these key asset classes, the next step that I generally take is going in and actually looking at, and I'll generally use like the 30-year, the continuous contract for the 30-year, as well as the 10-year. But I also look at the TYX.X and the TNX.X, which are the interest rates for the 30-year and the 10-year respectively. And so when I'm looking at this, understanding that, of course, there's that inverse relationship between interest rate and bond prices. Right now, I actually see that, interest rates have been climbing since those lows in March. So even with the short-term strength that we saw the summer in some of the bond prices, it wasn't enough to actually send interest rates back down to where they were back in the spring. And taking a look at where it is that the 30-year can actually go right now, I'm forecasting that interest rates can actually get upwards of about 1.9% to almost 2.2% on the 30-year, which is, about 300 to, not 300, but 40 to about, 140 basis points from where we are right now. Uh-huh. So if we do see that the interest rates are going up, then obviously we can see that bond prices might actually break down. Taking a look at the 10-year, currently right now it's at 0.92%. Yeah. I'm forecasting that we could actually get up to about 2.3 to 2.4% in interest rates before we see that it could potentially roll back over again. I mean, there is a spot at about 1.3. From an old support level that might act as resistance, but looking at some measured moves and looking at where some supply might actually be in terms of interest rates, they've got a ways to go. So I don't necessarily look at the steepening of the yield curve or anything of that nature. I mean, I know that those things are important, but When it comes down to these bonds, and obviously the situation that we're in right now, I mean, we're running record deficits.
Yeah.
So the only way that you're really going to entice people to buy our treasuries and actually put up with the fact that we're super in debt is to offer them higher interest rates.
Yep.
So I wouldn't be surprised to see them kind of go back up to that 2% area. Now with that, you start to kind of raise the specter of inflation.
Yes.
But even relative to where we are right now, I mean, we're nowhere near getting into, in a super inflationary environment. I mean, compared to
the 80s,
what we saw back in the 70s and 80s.
Yeah.
It's like when interest rates were at 15% for a 30-year. No, we've got a long way to go before.
Here, I actually just brought up the 10-year yield, and guys, the reason that I know not most, but many of you may think, well, who freaking cares? It's bonds. It doesn't impact me. Remember, the 10-year is what most mortgages are benchmarked off of. So if you see this bond, the 10-year rise significantly, well, that's going to impact the ability for people to buy homes. And of course, we know, I believe the number I looked at was 14 or 18% of GDP comes from housing. Yep. If all of a sudden housing numbers start to drop, that could have a big impact. Now, here's the chart of that 10-year yield. And yeah, of course, can you guys imagine signing on to a 16% 30-year fixed mortgage back in 1981? Hell no. It's beautiful to look at this chart, though, and think of where we are today comparatively. So I'm kind of scrolling through the decades here. Hard red edge is 2000, and we just kept falling and falling. So to see this thing jump from 50 basis points, which was the low that we saw back in 2020, right around 50 basis points. We've doubled in just the past 6-8 months. So it is significant, but when Scott has his target of 2%, it's really not that big. I know it seems a colossal move at this point, but that's not even getting back up to a historical normal level, right? And the historical normal level is like 5-6%, somewhere in there. Certainly a long way to go. But remember, as the reason that this market has been fueled and just absolutely gangbusters has been because these 10-year yields so low make money cheap. It allows people to buy more stuff, and that's the consumption economy has been driven by that. So if you see this spike up to 2, remember, the higher it goes, the more of a slight constriction it will pose on the economy. And I think that's an important piece to pay attention to.
Yeah, and I, it's like all of this analysis that I look at, it's really designed to help me understand like where we are within the longer term cycles. It's like a lot of times whenever I would teach class, I would ask somebody, it's like, what do you guys think that the average economic cycle is? And a lot of times they would say it's 3 months. And
3 months.
It's not. Yeah, I know, right? Now I think where they get confused is that, the GDP is reported quarterly, and of course we have all of these other preliminary numbers and final numbers and so forth. But it's important to understand that up until this last recession, going back into 2009, the average economic cycle was about 48 months, and now we are in this super extended kind of, I don't know, just it's a super extended economic cycle. It's the weirdest thing, but a lot of it is due to the fact that, going back into the latter part of the last decade, the early part of the last decade, we saw a ton of stimulus coming into the market through their quantitative easing programs, which completely distorted the amount of money inside of the market compared to what it used to be. Now they have basically done the same thing again due to COVID, and so all of this has long-term impacts on these cycles and how they actually play out and where the norms are. Honestly, I don't think anything has been normal for the last 12 years.
Yeah, I agree.
Which means that you have to be a little bit more proactive in looking at where we are in the big picture, understanding where those key technical areas are, so you recognize when an actual shift is taking place. Because I one of the challenges that I always have in working with students is to get them to understand that, you might see that a stock today was down 2 or 3%, but that 2 or 3% decline today actually represented a buying opportunity for you, because relative to what's happening on the monthly chart, it's in a major uptrend, and a 2 to 3% dip is a buying opportunity.
Yep.
And recognizing the difference between that and, let's say, a bear market where, if the stock is down 2 or 3% in a day, that's just kind of a normal thing. But yeah, so it's the long-term cycle that I pay attention to, and then based on that, I can then operate in the shorter term because I have a better feel for where the markets can go, where my risk is. I've always I've referred to it as putting the market into context. Once you have a proper context developed, then you can be more confident about what it is that you're doing, why you're doing it, and that what and why isn't necessarily being driven by what's being said on CNBC or some analyst report that you've read. That's where a lot of people go to get their why.
Right.
For me, it's all driven by price. So
I agree, and it's funny because to that effect, we were laughing about this with some of the audience members the other day. You look at CNBC and Fox and these ones, and a lot of the times they'll find something for the day, and their justification for the why is, like right now, it's stimulus. And then, it's no stimulus. Or it's either vaccine good news, market was up today. Market was down, it must have been vaccine bad news. And we always have these little things the market hinges on, but bottom line is it's just price, period. Wherever you want to make the excuse for, it's just price.
That's why I would be the worst guest ever on CNBC. If they asked me why the market's going up, I would tell them there's bigger buy orders than sell orders.
Honestly, I think you'd make one of the best guests out there. Let's move into. Let me see. Like anything else here? There was a question. Patrick, this is a good question. Patrick goes, do you incorporate gold and real estate into your analysis of the market's health?
So I do look at gold. I don't look at real estate specifically. Because and I guess in a way I do. So let me go back to gold really quick, and I'll talk about the real estate side of things just to kind of clarify. So much like I look at the TLT versus the SPY, one of the other comparisons that I look at is GLD versus SPY. Now, of course, if you wanted to, you could use the actual gold contract versus the S&P cash index. The only reason why I use GLD versus the SPY is because most people, you don't have to have a special subscription to data in order to get that information.
Right.
But when you take a look at the relationship of gold versus SPY, really what you're starting to do is kind of develop a sense of paper versus physical assets. And so if you were to look at this ratio going back from like 2007, it actually started back in like 2003 and 4, going up into 2011, 12, gold severely outperformed the S&P 500. Mm-hmm. So even though both were going up at the same time for a few years, it was a situation where you would want to have more money in precious metals than you would inside of the S&P 500, for instance, because your rate of return would be higher.
And Brandon's not here. He's our gold and mining bug on the show today. He just took off. But Brandon, you would have been loving this.
Yeah, so it's always, I always love showing this chart to gold bugs because gold bugs will always find a reason that you have to own gold.
Right.
And what's interesting about this chart is that when you're looking at this ratio, it actually topped out in like the fourth quarter of, or actually I guess the third quarter of 2011. And really kind of reversed the trend throughout 2012 going into early 2013. But since then, gold has really been underperforming stocks up until about 2019 when we started to see a little bit of strength coming back into the market. And, obviously with the sell-off that we saw in March, gold kind of became a safe haven of sorts, for the markets in general. But since March, it's actually been drifting back down again, which is a little bit odd because the GLD itself didn't top out until August. So with the performance of GLD now kind of drifting back down, a ratio level of about 0.43, 0.42 is going to be pretty important. Mm-hmm. Because if we break that, then it actually suggests that we're going to see paper assets outperforming gold again. But if we actually see it kind of cross out above that 0.62 area, which represents the resistance area from the spring of this year, but if you go back into 2016, you'll see that there was a couple of short-term highs and around that same spot at about 0.63. If we break that, that's going to be very significant because it actually reverses the long-term downtrend that we saw throughout 2012 going into 2019.
Yeah.
And so at that point, what that would tell me is that, I need to shift more money back over into the physical aspects. But it would also tell me that I need to look for material stocks to also become a relatively strong sector, which, interestingly enough, since the spring, material stocks, the XLB, so if you did a comparison of the XLB versus the SPY, this has actually been one of the best performing sectors since the spring. And if we continue to see that, then I wouldn't be surprised to see that the GLD actually crosses this ratio again, or this ratio crosses above that 0.62, suggesting that, gold is a place to be. And it could be a place to be simply because we're getting later into the economic cycle. We're getting later into the stock market cycle. Interest rates are going up. So
wait, you said real quick. You said you were talking materials. You said XLV. That's not
no. XLB is in Bravo.
Oh, B. Okay, sorry. I was thinking, I'm like, wait a minute. Why am I typing V? That's healthcare.
Yeah, no.
All right, so I'm trying to keep up with you, man. So here you go. There's the basic materials, and yeah, I mean that's been a monster rally here recently. Loving it. I think a lot of this has to do with both elected officials talking about a need for infrastructure and bringing jobs back through infrastructure and programs like that. So that was something that we heard back in the 2016 presidential election debates. Is all about infrastructure, new roads, and I think now you're starting to see maybe more possibility of that expanding. So good.
Agreed, and when you I pay attention to the relative strength ratios for each of the sectors versus the S&P 500, and when you take a look at where we are right now, materials have been outperforming, and recently industrials have actually broken out above their prior high from the second quarter of this year, indicating relative or an increase in relative strength. So that to me is pretty important because when you look at it from a sector rotation standpoint and you compare that to the market cycle, these are the sectors that typically lead during the mid to latter part of that market or bull market expansion.
Right.
So the fact that we're finally starting to see these two sectors, which have been underperforming for years, starting to show some real signs of strength, it just adds more evidence to this bull market is maturing. The equity markets overall are most likely going to continue to move higher. With the increase in the XLB, yes, I would be looking to, metals. I mean, if you take a look at copper in general, if you just break out like a price chart of copper, you'll see that we're trading at levels that we haven't in a couple of years.
Well, and just for the viewers at home, I know, and also the podcasters, I'll put in perspective from the lows that we saw from the COVID lows in March to where we are right now, which is off the highs a little bit. You're looking at a 73% increase in copper in 263 days. That's pretty stellar. And I'll show you a weekly chart here so you can see kind of how it stacks up. These aren't really normal moves. Even though, metals tend to have extreme volatility, this is certainly a pretty dramatic move for copper.
It's very dramatic when you take a look at just the steepness of that move. But what's interesting about the steepness of this incline so far, if you go back and you actually compare that to the rate of increase from the lows of 2009 going up into the highs of 2011, or even those from 2004 going up into 2006, it's nearly the same rate. So it's not impossible for it to do that again.
Yeah.
And if you're looking at a monthly chart of copper, if you do a measured move of the impulse swing from the December 2008, January 2009 lows up to the highs of February of 2011 and project that from the lows of 2016, it would actually put copper in and around about 533. So compared to where we are right now, I mean, that's still a very significant increase in the value of copper.
I'm trying to follow along with you, man. You move quick, but you know what?
Sorry, yeah, I've got a chart going back to like 1999.
No, I got it. I got skills, man. This ain't my first rodeo. What's interesting is, well, I don't know if I have the exact same numbers as you, but I just moved that line up, and you guys can see it's just around that $5 mark. It's about $5.09, which is dead smack on to the peak that it had before.
Yeah.
Actually, just a little bit higher. I'm sorry. So that peak would run to 525. So
Yeah, if I'm using the at HG equals 120XN.
Okay.
So we might have a couple of different prices, but yeah, I mean, the fact that it's forecasting a price that's double from the lows that we saw this spring, more than double. So all of this information, obviously, if once you kind of assimilate everything here, you can take this and say, okay, well, let me go find some mining stocks. One of the stocks that I recommended in the XLT back in August was FCX, Freeport-McMoRan.
Yeah.
And this thing, we were looking at it in and around. We actually picked it up like around 1470 and change. So that low there in September, and we continue to trail it up. The target that I've got on it is about 35 right now. So it's just been doing extremely well. And what's frightening is that from the lows there in March, I mean, the stock is up nearly 500%.
Yeah, not bad. When we look at something like this, so I'll go from the lows, like 427 is what I've got for FCX in that weekly.
Mm-hmm.
Obviously when you see something like this, my gut feeling is always like, I don't want to buy into this thing right now. I would not buy into FCX or whatever chart looks like this, because to me it's just overdone. I'm going to wait for those pullbacks. What kind of legs do you think this has in it? I mean, I'm looking at the weekly, but if I go out to the monthly on something like this, all of a sudden your eyes widen and you're thinking, well, is the 37.50 mark going to be there? Or are we going back up to 60? I mean, what's the upside for something like these material companies like Freeport?
Sure. So, in looking at Freeport, like the first thing that really stands out to me is that if you look at a monthly chart, and again, I've got a monthly chart that's going back into 1995. And so when I'm looking at this, I see the lows there that took place in 2016. I see a relatively equal low there in March. And the fact that we've actually traded out above the February 2018 highs, to me, when I see that, I think immediately double bottom.
Yeah.
And so, when you are doing a price objective on that, the old rule of thumb is you measure the height from that midpoint down to the lows, and then you project it from that midpoint. So projecting the entire height of that double bottom pattern from the $20 area where it broke out from, it gives us a target around 36.89. And what's also very significant about that is that if you look at it back in June, July, September of 2014, it basically formed a rally-based drop right there.
Right.
So I wouldn't be surprised to see it get up to that area before it starts to slow down. Now, obviously, there is an old support level at about 26, which we're about 10% away from right now, and we could see it go through a retracement. But this is kind of going back to the what I was saying earlier. What do we know about the stock? The stock is doing extremely well. There's the potential for a lot more upside. Would I buy it here right now? Probably not. I would probably look for a retracement.
A little bit, yeah.
To some degree, kind of like what we saw in September.
Not saying you're going to buy it at $5 or $10, but 20 could be appealing.
It's and that's the thing. It's like, going back to where did it break out from? It broke out at $20. There's going to be some people there that missed that trade, and they're going to want to buy in and around $20. If you can also find a demand zone in and around that area, there's one, basically at 1990 to 1921 on that stock, and there's another one just above that at about $20 to $21. So depending upon who you are and the types of strategies that you're using, you either need to be really patient, or maybe you can sell some $20 puts on that that are maybe going out 3 to 6 months and try to collect a little bit of premium on that while you wait. So there's a lot of different strategies that you can use to exploit the situation. But at the end of the day, what it all comes back down to is having a process to identify what areas of the market you're actually going to look at, and then kind of roll up your sleeves a little bit and go in, look at those areas, see what stocks in this case are doing well, and then strategically identifying where would be a more opportune place for us to be a buyer,
right.
For a stock like that.
Oh man, we could keep going on and on. There's so much to talk about. I want to keep going, but I'm looking at the clock right now and I'm like, we're going to run out of time. Real briefly, I know that some people here are, in your sessions and know how to get in touch with you. Others may have no clue who you are or what you do. Tell me a little bit about your guided GPS or guided pathway sessions and how people might participate in those.
Yeah, so one of the things, so Online Trading Academy is the company that I'm contracted by, and one of the things that I do for them is I produce what's called the Daily Market Overview, which is basically a daily newsletter that covers 11 markets. So I cover the 4 major broad market indices: Dow, S&P, NASDAQ, Russell 2000. Every morning I take a look at the 30-year and the 10-year Treasury. And then I also look at gold and crude oil every day. And I'll give, basically two demand zones, 2 supply zones every day. We take a look. I identify the daily and the 240-minute trends so that they have an idea as to whether they should maybe be bullish or bearish. But then every day, like after I publish that at about 4:50 your time, 7:50 Eastern, we go through and we take a look at each of those markets, and we try to give some commentary around that. So I usually spend about the first 15 to 20 minutes every morning going through those sessions, kind of covering this information, giving the rationale as to why I'm looking at the areas that I'm looking at, what I'm watching for next. And then from there, it's followed up generally either by Brock Pierce, Jeff Manson, or Brandon Wendell, where they go through and they look at some other markets, Bashir Shai as well. They'll talk about specific stock trades or Forex trades or futures trades that are more intraday to swing trade. But, any of our mastermind students have access to that, Monday through Friday. On Fridays, we open it up to XLT students. So if you're an Online Trading Academy student and you're either a mastermind or an XLT student and you're not going into those sessions, they're open to you. You just go to your calendar, click on that. You'll be able to launch it about 20 minutes before the session starts. And, we've gotten a lot of really positive feedback from our students. It's been about 3 months now, 4 months actually, since I became involved in going through and providing the daily market overview. And every Monday I'll do like a weekly overview. And the first week of, the first Monday of every month, I go through and kind of do like a monthly highlight, just to give them the big picture perspective and let them know like where the big changes are happening.
Yeah, I mean, I would encourage all of you to, if you do have access to it, to participate. For those that, a lot of people I've learned don't have, they may have an XLT and they just don't use it. Look, this is a great resource for you. If you're mastermind, you're probably much more active in the community. But I'll just show you guys. Here's the calendar that if you're a graduate, you log into my OTA. And this is all the stuff that I have access to. It certainly will be limited to what you guys are participating in. But right at the top, it's the early morning one, GPS mastermind session, Monday through Thursday. And then there's a GPS session on Friday that's open to XLT. So to me, very valuable pieces for you. And as far as, it's not saying that these are the trades you need to make, but it's what to be aware of. I think as traders and investors, it's our goal to look at the broad picture, see where we stand in relationship to whatever the markets are doing for that specific asset class, and then formulate an opinion about what we want to do going into that day. Map out your trades and make those trades. And don't hold too strongly to the opinion, but at least you need to know what's going on. Scott does a great job about looking at the critical levels and where things are headed. So that's why I love having you on. One last piece here, Scott. Mm-hmm. I think we need to change the Beck report name, because you've got the bonds, the B, equities, E, currencies, C, commodities, C. And then I think you need to put cryptocurrencies in there. Are you still not on board with the cryptocurrency world?
I'm not, and what's funny is that I used to teach a lot in Dallas back in like 2012, 13, and there was an educational counselor there at the time who was all about crypto and Bitcoin. And looking back now, it's like, dude, just if you had just thrown a couple grand in there, it'd just be a game changer here today. But I mean, it's one of those things that I don't really follow. And at the time I didn't feel secure enough, and until it becomes a little bit more regulated, until I felt like, somebody couldn't hack into my account and take the money. I have opportunities elsewhere.
Go.
So it's not quite there yet. So I guess eventually it might become the back report.
He's got a really strong slur, back report.
Right. So I had to work on that. But
nice.
But yeah.
Well, all right. Well, cool. Obviously, I'm a fan too, and I know who you're referencing from Texas. Did very well. I'm curious to see whether they actually sold out because they had a monstrous position.
Yes, they did.
In one cryptocurrency, and then that thing fell apart. So hopefully they got themselves out of it and locked in some of that profit. But all right. So what else you do? You're doing Beck report, or not Beck report? You're doing the GPS sessions. You're doing XLTs and anything like that?
I've not been scheduled for anything of late. I've just been focusing on doing our grid development in the morning, doing the daily market overview, and keeping the rest of the day to myself. So it's actually been a pretty interesting but time-freeing year.
Yeah, absolutely. Well, hey man, thank you so much. I do appreciate you coming on. I always want to talk about what you're doing and promote what you're doing, get people to see you at OTA because you do some great work, and look forward to having you on in January, my friend.
Thank you, sir. I look forward to it. So until then, Merry Christmas, Happy New Year.
That's it. Happy Hanukkah, Menorah, Kwanzaa, whatever festivals you guys want to celebrate, just be happy this year. Scott, thank you so much. Look forward to talking to you soon, my friend.
Thank you.
All right, take care. Guys, that was Scott McCormick. As you can tell, I mean this in a very nice, affectionate way. He's kind of like Rain Man when it comes to the markets. There's certain people who just absorb information and they're robotic about what they do. And sometimes I saw a comment earlier from an individual saying, he talks way too fast, he moves way... Because this is what he does, man. It is so ingrained in him, and I'm just happy to have him on the program once a month. I'd love to have him on even more, and I'll see if I can get maybe his Beck report to be put out there. I think that's something that's extremely valuable as well. For some of you, I know the conversation was just way over your head. That's okay. If there are questions, feel free to send those on in. I know that some people... in the chat here today, or just listening, watching the show, are too shy or too embarrassed, thinking that their question might be stupid because the group here is generally advanced. Don't worry about it, guys. I'll handle when Big Eb gets upset because you asked a silly question. It's about making sure you understand the topics, and we all would bring each other up. And if I don't get your question, somebody from the group probably will and help you out. So don't feel like there's too stupid of a question. Well, let me take that back. There are stupid questions, but I'd much rather you guys ask a stupid question and get it fixed than correct a stupid mistake that you make in the market, because answering a stupid question is easy and doesn't cost you anything. Fixing a stupid mistake in the market can be extremely expensive. So there you go. That's my 2 cents on stupidity and questions. Don't worry about being stupid. Just ask it. If it's really stupid, that's fine. We'll get over it. All right, what do I got for tomorrow? Earnings front, I don't really have anything that's noteworthy out there for tomorrow, but this is what I've got cooking on the economic calendar front. You'll see you've got for the U.S., there's only really 3 announcements. That's the NFIB Small Business Index. Surprisingly, or not surprisingly, the numbers have been relatively high for the NFIB small business. Remember, Russell 2000 is small cap, so it's expected to drop just a little bit here, but it's really where everybody is focusing their attention on right now is small cap. So that'll be an interesting number. That's well before the market opens. And then an hour before the market opens, we get non-farm productivity and unit labor costs. Those are the 2 kind of major ones happening for tomorrow, but they're not that critical. What's more important is what's happening for the euro. Now, we didn't really look at the euro today. We saw the dollar kind of stabilize over the past 2 trading sessions, or maybe I'll show you that one here if you haven't seen it. At 2 a.m. Pacific time, I know most of you will be fast asleep. That's okay. It's a big day for the euro. So if you're trading the euro dollar, you've got GDP and then also the ZEW Economic Sentiment Report. So there's 2 different versions of the ZEW. Most people focus and put more emphasis on the German one because that's kind of the hub of what goes on with the European Union. But they're both valid. All 3 of those numbers come out at 2 a.m. Other than that, not a lot of other really important stuff. I mean, manufacturing sales in New Zealand really isn't going to draw too much of a market change out there. But that's what we've got cooking on the economic front, and that's about it. No real news on earnings as well. There were a couple names, but nothing that's overly impactful for this week. I think actually this week is really boring with regards to earnings announcements, except for Thursday. I'll let you know more about that as we get to our Wednesday show, but Thursday is a pretty important day with regards to earnings announcements. All right. I think that's going to do it for me, everybody. Hope you enjoyed Mr. McCormick. Again, if you are a Mastermind community member and you just decided you're just not going in there, go in there and get in those GPS sessions. It's incredibly valuable to have the brain of Scott McCormick and to others. He's not just the only real smart guy that we got working there. There's a lot of really intelligent people. Use their brains. Let their thoughts help you formulate opinions about the broad market, specific industries, sectors, trading opportunities. I think there is a ton of opportunity out there. So, I've talked to people before and they go, I paid for XLT. I just don't use it. Well, then why did you pay for it? Use it. There's a reason why you buy those things. So again, for those of you who might not know what we're talking about, Scott works for Online Trading Academy, and he teaches a GPS session Monday through Friday. Of course, there's plenty of other classes. To find out more, you can just go to tradingacademy.com if you are new to the whole thing and find out more information there about which center might be closest to you, and hopefully they can help you out. Yes, Big Eb says, better a dumb question, which there are not many, than a dumb trade. Yeah. I just love the correcting mistakes, right? Because a lot of times when I used to teach the physical classes for OTA, I would force people to ask questions because some people get shy and they're worried that they're going to be embarrassed because somebody asked a question. Look, most of you guys are just hiding behind a name on the screen. I don't know if Big Eb is actually Big Eb. That could be my boss. Who knows? I don't know who they are, so don't worry about asking questions. Ask them. It will. It's good to help everybody learn, and of course, there's a lot of people in here who are smart enough to be teachers, and they'll probably help out along the way as well. All right, everybody, that's going to do it for me for today. I haven't confirmed, but Matt Leising, I think, I hope I pronounced his name right. Matt Leising, who wrote the book Into the Ether. It's a book about Ethereum and about the $55 million heist and just kind of the background of Ethereum. I had him slated for tomorrow's show, but he's like, you got to read my book first. And I was like, oh, man, you know how slow of a reader I am? I'm a doer. I'm not a reader. Get my hands dirty. That's what I like to do. Hopefully, I'll have him on the program tomorrow. I'll reach out to him, but it'll be someday this week, which will be very interesting because as we continue to grow the cryptocurrency world, Ethereum will become a more and more significant player in that space. And I think it'd be a very interesting discussion to hear the history and what the prospects are for its future with Matt, who has been covering this for Bloomberg for many years. So hopefully that'll be the guest for tomorrow. Not 100% sure it's going to happen, but I'll try to make it happen this week. That's going to do it for me, everybody. Hope you have a fantastic show. Hope you have a fantastic remainder of your day. Stay safe, stay clean, wear your mask. I'll see you guys tomorrow. Take care.